Hello, everyone. This is Rob Golfi with REMAX, the Golfi Team. Welcome to the Golfi Real Estate Show, Hamilton edition with host Rick Zamprin.
A glorious day here in the city, and it is exciting to have you on board for another edition of the Golfi Real Estate Show, Hamilton edition on 900 CHML. As Rob mentioned, he's a sales representative with REMAX Escarpment Realty, the Golfi Team. My name's Rick Zamprin here on 900 CHML. We're going to talk a lot about real estate, about mortgages. We have a special guest with us today. But before we get to all of that, I got to remind you that if you want to sell your house or you're in the market to buy a home, there is one team to call, and that is the Golfi Team. And speaking of one, they're number one in the country. Call them today at 905-575-7700. The website is robgolfi.com. That's robgolfi.com. And they're on Facebook and Instagram, TikTok, X as well, delivering the hottest listings in town. And you can get your listing on robgolfi.com. Our special guest today is no stranger to the show, Brian Hogden, principal broker and founder, Mission 35 Mortgages, online mission35.com, has also written a book called How to Get Mortgage Free Really Effing Fast, the book on how to pay off your mortgage in Canada with 10 simple steps. Might be a few more steps added since the book was launched a while ago. But Brian, Rob, welcome to the show. How are you guys doing?
Doing awesome, Rick. Thanks so much. And especially tickled pink with that rate drop the other day. So I got a big smile on my face.
Absolutely, yeah.
I don't know if it's going to, you think it's going to do anything? I don't know about that. I don't know.
I don't know either, but you know what? It's better than standing still, and it's better than going up. So
That's right.
I always take progress over perfection. So the fact that it's moving in that direction, I will hold my low rate flag very high and say hallelujah.
So in the newspapers, all the press is coming out. They experts are saying they don't think it's going to move the market at all. And I don't think it will either.
Yeah.
I don't think it's going to move the market. I think it's going to take a little more than that. And the government is just taking their time. They just don't want to have a flurry happen, and all of a sudden it just goes out of control.
I think you're absolutely right. And a telltale sign is we received over 100 phone calls yesterday. Over 100 phone calls that said, does this affect my mortgage? So you know how many people right now are thinking, oh my gosh, I need to take a valve out of this pressure cooker right now because it is getting expensive. So quarter point, it reflects $15 on 100,000. It's been a half a point over the past couple months, but I do agree it's got to go down a lot more still for people to feel the savings and to end up saving that cash flow. But I like to also look at we're trending in the right direction, right? So it's hopeful. I don't think we're there yet. I think there'll be a marginal bit of people that might jump on the bandwagon.
And I think one more quarter point, that's where you're going to start seeing the needle move a bit. I think, and if they do that this fall, I absolutely will see. You'll see the market.
I think it'll be, because then if you see it in September, 0.75, I think we're going to be closer to 1%, especially because the big bad news that's going to come out is probably in the condo market as well, too, with all these new condos coming out.
Oh, yeah.
Investors have dried up in the condo market because you just can't cash flow buying a condo these days.
No way.
So there's going to be a lot of inventory that comes out. So I think we're trending in there. I think by the end of the year, the economists are saying we'll be down 1%. Right, so that's another half a point, whether it's September, October, November. So we're getting there.
Yeah, I honestly feel like I knew there was going to be a price drop, and I knew it was going to be a quarter point. Pretty well, most people expected that.
But that's what we want. See, they call him Crazy Tiff, right? They don't want to see Tiff Macklem. Yeah. You want, when there's certainty in the marketplace, it makes the marketplace feel certain. So everybody thinking that there was a quarter point rate drop and there being a quarter point rate drop actually helps give the market a little bit of stability. Because if he didn't drop it, then it'd be like, what's going on?
So I found June was a good month in real estate. Now, I don't know. And that was just like a quarter point, but it was fairly decent. Not crazy decent, but it was decent. But I think there was confidence. Then it slowed right down. It stopped. It said, okay, the first 2 weeks of July were not as busy as the first 2 weeks of June. And now with this price drop, my feeling is that, okay, we're going to see some confidence coming back. We're going to see people, looking, because they can lock in at a mortgage right now. How long so if I'm a buyer right now, Brian, and I'm looking to lock in an interest rate, how long can I lock? Is it 120 days or 90 days?
Yeah, you can lock in 120 days before, sometimes 90 days, depends on the lender. And the thing too to remember, like if you're a first-time buyer right now and you're putting down less than 10%, you know what the rate is you're getting for a 5-year fixed right now? If you're putting down 10%, 15%, you're getting like 4.79.
Yeah,
you can even get 4.69, 4.74. So these are not high rates right now.
And there's people out there that renewed their mortgages at 6.5%. So they renewed at 5 years at 6.5%. So they got another 4 years of that to go at 6.5%, which is sad. So, yeah. but I want to tell you a story. I have a client that built another house, and he's got a bit of money that he can carry 2 houses. Okay, and he called me up this week and said, Rob, what's going on? What do you think? And I said, listen, they did a price drop. I don't think it's going to move the needle. And he's got a house that's probably about $1.6 million, which it's in Niagara Falls, actually. And it's not an easy number.
That's a high point up there, right?
It is a high point. And he's trying to determine, do I wait 6 months or a year to sell when the interest rates are down maybe 1.5 point, or do I just sell it and bite the bullet? And then he's asking me about leasing the house. And I said, you can lease it, but I go, you take a risk. I said, a lot of people don't want 1 year lease. And if they say yes, and then they don't leave for 2 years, and then you got problems. And now, so I said, you got to look at all the scenarios. We do everything in our power to get the right tenant in there and everything else like that. But so he's trying to figure out what to do. Like he's trying to time the market. And I just don't get it. Like, how much of a difference could it make? It could make $100,000 difference. At
that price point, I think it
can make $100,000 difference. So,
but then how much are you going to lose every month? Because probably whatever he's renting it for probably wouldn't cover. Depending on how much money he's got.
He's probably got it paid for. I'm assuming.
Oh, okay.
Yeah, he's probably got it paid for. So, that is a big question, and I'm giving all different scenarios. I think he was more confused after he got off the phone with me. Then it's like, because you don't want to direct him in a way to go that direction and it doesn't work out. Right. You kind of give him the scenarios of two different directions. Now it's up to him to decide which way. And, you give him the positive and negative of each direction. And then.
And what the risk is, right? Because not only do you have the risk of someone not moving out, but like, is that property going to look the same?
Exactly.
Right. 12, 18 months from now.
Yeah. They have a couple of big German Shepherds living with them. Obviously, the German Shepherds weren't on the lease. And then all of a sudden they show up knocking on the door and say, hey, why'd you leave me at the last house? I thought you were going to bring me with you. And meanwhile, the landlord is going, what? I didn't know you had dogs. Yeah, we left them at the other house. I guess they didn't want to stay there.
It's interesting too, because I have a friend right now. He was going through a separation. He was looking at places to rent, and it was cheaper for him to rent a high-end condo right now than it would be to buy one.
Yeah.
And it was a conversation right now because he's looking at, somewhere he wanted to have a nice place, and it was going to cost him almost $4,000 a month in rent versus probably a $6,000 mortgage payment. Yeah. So
it is actually cheaper to rent a condo now than buy one. It is. You can. It'd be like your payments would be cheaper, but obviously you're not building equity over time. But your payments are cheaper.
Right.
So what is in this person's case, in this scenario, what is the risk to hold on to it, knowing that he can carry it? Wait till the spring. We know mortgage rates, knock on wood, are going to continue to go down. What is the risk of holding on to it?
You know what? Anything can happen. There's a risk of him hanging on to it that maybe the market can turn. Who knows? Like there could be a major devastation anywhere that could happen in Ontario or in the world or anything that could cause problems like that.
And like we've talked about before, pen stroke economies. What? All of a sudden you get a pen stroke change in government policy that changes. We've heard crazy things about capital gains being talked about on principal residences. But I also think too, if you buy a property, I think it's what was the intent? Did he intend to rent it? He didn't intend to rent it.
No.
You know, and that's not a rental property. If you bought a property with the intent to rent it, you rent it. But it's a beautiful home.
It's over 3,000 square feet.
And it's not meant to be a rental, right? You run the risk of having a tenant that doesn't take care of it. Now, maybe you've got $100,000 of renovations when you turn around to go sell it when they move out. Or like you said.
And the aggravation of renovating it.
And maybe they don't move out. Like we've talked about this many times. The landlord-tenant board's still backed up. If you get a professional tenant in there, when you want to go to sell it, you may be in a position where you're handcuffed.
Yeah.
So, and then try showing it with the tenant sometimes. Too.
Yeah. Good luck. Yeah. So.
And I guess the question that this homeowner is asking themselves too is how much, if they're trying to time the market, how much is it going to change between now and let's say the spring? And the answer could be a lot, right?
It could be a lot. He's willing to. He's trying to figure out, should he roll the dice or just do it now and just cut it loose. And I told him, I said, put it up in February of next year. Just maybe hang on to it. Or if he rents it for September, because he wants to rent it for September 1st, that means it's a year September. So who knows? Like, you know what I mean? Like who knows? Like he's going to sell it in the fall of next year.
Right.
And if the tenant does, he basically says
this guy sounds pretty savvy. If he's got $1.5 million house paid off and he bought another house, I bet you
he built another house.
I bet you he's got a business that does pretty well. I would probably say just focus on your business and sell your house.
Yeah. That's
right?
it.
Because this kind of stuff can take up so much.
Bandwidth.
Yeah.
He's trying to fit that market so tight, and you know what? Got to be careful about that.
Yeah.
We got about 90 seconds in this segment. Is he at all considering short-term rentals?
That's
AKA
6 month rental. Yeah, people are in between moves and they need a 6 month rental.
That's actually a bit safer, I would say.
It is safer because people are waiting for their house to be ready to move into, and which is probably the best way to go.
And he'd let it out furnished then, like do the whole 9 yards that way?
Probably not. I guess short-term rentals, they just got people put them, I don't know, like short-term rental, like, you know, people are in between moves. Yeah, you're right. Like they probably would Airbnb an Airbnb instead of a long-term rental.
Oh, interesting. I know there's a market for insurance companies as well too. Whenever there's like a fire or something like that, I have a friend who does that, and there's a shortage of properties
of those.
Yeah, because you have a fire, you need a place to go, and you want to have a furnished home instead of staying at because the Airbnbs are less now, and you don't want to stay in a hotel.
Let's get into whether or not, if you have some dough left over at the end of the month or the end of the year, whether or not we should overpay on our mortgage. Ryan, what say you?
Well, I have to be honest, Rick. It's been a long time since someone been banging on my door and said, I've got a whole bunch of extra money and I'm going to throw it onto my mortgage with these rising interest rates. So, you know, with that being said, though, I'm a big proponent of doing both. Like, I think you should save outside of your mortgage and put money down on your mortgage. I think both, right? And one strategy that we used to do a lot of, and of course, with interest rates high, we're just trying to have people pay their mortgage right now instead of paying the overpayment. But what we used to do all the time is end up saying, you know, if you've got a job, put your money into RSP contribution because it's good for some Canadians to have some RSP room. And then with the refund that you get from your RSP, make a prepayment to your mortgage. So then you got a little bit of both. You got some RSP room, and then you got a prepayment on your mortgage as well too.
The other thing is they always say go bi-weekly on your mortgage payments. That drops down. How much does it take? 5-10 years off the mortgage?
So if you're on a 25-year amortization and you're paying it monthly, and then if you end up doing accelerated bi-weekly, so essentially what happens, you get 2 extra bi-weekly payments every single year because there's 12 months in the year. You multiply that by 2, it's 24, but you'd actually make 26 bi-weekly payments.
Right.
Sorry, I sound like the Rain Man when I talk about this.
Yeah.
But what ends up happening, it saves almost 4 years on your mortgage, right? Just by paying it bi-weekly.
It takes 4 years off. So you'd be down to a 21.
Like on a 25,
but
21,
I thought it was a lot greater than that. I thought it was greater than 4 years. I thought it was close to like 8 to 9 years.
No, I think it's about 4.
On a bi-weekly. You know better. You're the mortgage guy. So.
Well, I'll check my numbers.
Yeah, no, but
it's a benefit.
It is. So but it's always, I think it is.
Or even weekly, right? Yeah. Like even weekly, because what ends up happening is the principal goes a little bit quicker down, right? Because you're making
Would weekly take it down more than 4 or 5 years?
Not much. The biggest difference comes from going monthly to accelerated biweekly. And I think what you need to do is make sure you don't just say biweekly, because some banks will do it biweekly where they take your monthly payment, divide it by 2.
And yeah,
That is actually the accelerated one.
Right.
But if you take the monthly payment times it by 12 and divide it by...
so basically you got an extra mortgage payment a year. Like
Correct.
Yeah.
Yeah.
A full
You got an
mortgage.
extra mortgage payment, and that goes directly on, not directly on the principal, but it's saving you about 4 years on there, right?
That's amazing.
Well, it's a little thing because most people get paid biweekly. Like if you have a job, you get paid every 2 weeks.
Yeah.
Then it comes out of your bank account every 2 weeks.
Yeah.
You don't really miss it. You're not budgeting for it that way.
Yeah.
It just kind of like happens automatically. So
Yeah. No, good way. Definitely a good way.
Brian, do you have a percentage of clients that you've dealt with that have accelerator or even biweekly compared to monthly? Are most people in the biweekly category?
Yes, I would say most people are in the biweekly category. We advise everybody go biweekly if they can go biweekly, right? I think if you're an investor, rental property, typically you'll go on a monthly because it matches up with your cash flow. And there's not as big an advantage to pay off your investment property as your primary residence, because we're always advocating pay off your primary residence as quickly as possible.
Yeah.
Once that's paid off, hallelujah, then start to pay off your investment property debt if you want to, right? So I would say majority of them that we deal with are on a biweekly basis. If someone is struggling with cash flow, we would put it on a monthly.
And is that something you can change within the mortgage? Say you got a 5-year fixed rate or 2-year. Do you have to wait for it to be at the renewal stage?
That's a great question. No, you don't. And one little trick is, and what we've done for people is, if you get yourself into a pinch, it's actually a lot easier to go from biweekly to monthly than it is to go from monthly to biweekly. Because if you think about it, let's say, I've got my payment, because you always pay a mortgage payment. They call it paying it in arrears. So like when you pay a monthly payment, it's for the previous 30 days. Or when you pay a biweekly payment, it's for the previous 2 weeks. Whereas like when you rent a place, you pay on the first of the month.
You pay in advance.
That's
right. When you close a deal, your mortgage payment, your first one's 30 days later.
Correct.
Yeah.
So just, a little hack out there. If you were in a little bit of financial pinch, to change from biweekly to monthly will buy you some time because you're paying it in arrears, right? But if you want to go monthly to biweekly, you got to make that monthly payment, and then 2 weeks later, you got to make the biweekly payment.
Right.
So it's a little bit more expensive.
Yeah.
And is that a negotiation you have with someone at Mission 35 or some of the big banks or credit union? Like, how does that work?
I think it just comes down to service, really. At the end of the day, this is something that your mortgage advisor should be educating you on, right? Like some people, some banks will say, hey, tick the box. You want weekly, biweekly, or monthly? What do you want? Whereas, an excellent mortgage agent would be apt to educate you on these types of things and say, the benefit is if you go biweekly, monthly, tell me about your cash flow. Tell me about how you get paid. Right? And try to match the needs with the goals.
Mm-hmm. So those that get paid twice a month, whether or not it's biweekly, not just, 2 times, like the 15th and the end of the month, which I think a lot of people do, would a biweekly mortgage work for them?
It's a great point. That's semi-monthly. So, there is no benefit there. So some people do get paid on the 1st and the 15th, which is not the same as biweekly. Right. So for those of you that get paid,
those get paid on the 1st and the 15th are usually people on salary.
Right. Well, and then when you get paid biweekly, like I remember when I got paid biweekly, I got so excited. There's 2 months in every year. I got 3 paychecks. Right. I was like, oh, that's one of those months I get 3 paychecks.
That's right.
So, on the other side, those 2 months out of every year where you make 3 mortgage payments. Right. But when you're semi-monthly, it's always 1st and 15th or 15th and 30th. So there's no benefit there. But if that aligns with your payment schedule and it works for your budget, that works too.
Mm-hmm. I find this fascinating because I'm the 1st and the 15th. I'm on the salary. My wife is biweekly, like every other week she's getting paid. Right. So it's really
so she gets
almost like a catch-22.
I've got the best.
She gets an extra couple of paychecks a year.
Yeah, and it makes sense. You line up the mortgage payment with your wife's income.
Yeah.
No, just kidding.
I know where I'm going with this.
Brian said you are supposed to pay the mortgage, honey.
That's right. It lines up better with you, not me.
It's financially prudent if you pay the mortgage is what I'm getting out of this.
Yeah, I'll let you know how she responds. Okay. We're talking about real estate here on the Golfi Real Estate Show, Hamilton Edition on 900 CHUL. Rick Sanford with Rob Golfi and Brian Hogben. Next on the list is, trying to to determine whether or not, if you're putting your home up for sale, whether or not it is time to slash the price. You're looking around. Some homes aren't selling. The listings are just, waiting and wafting in the wind as potential buyers drive by and not really wanting to, make a submission on an offer. Rob, is it time for some people to relook at the price tag and say, okay, maybe we got to drop this price?
Yeah, you know what? And a lot of times people have overpriced it, and we're chasing that market to the market value it is. It depends on the person if they are, I'm not saying motivated, but I'm saying they need to sell and either they're upsizing, downsizing, relocating, or whatever, or going into a retirement home, whatever. Everything is based on market value. The buyers are out there. They're always looking, no matter what, more so in different months than others. But the inventory is climbing because everybody is overpricing their house, and eventually they are doing a price adjustment to the market, and then it'll sell. People know the market better than the realtors and the home sellers. They know the market better because they're shopping. They're the ones that are comparing, and they know the upgrades. They know the lot sizes. They know the conditions of houses, what it'll take. The buyers are more savvy now than ever because I think the parents of these young people, especially buying, they're educated more and they're being more vocal, and they've went through problems in buying houses. Like they're like, you know what I mean? Like the guys that are in their 40s and 50s that are looking for houses for their kids, they're smart. They're smarter, and because they're savvy is because they are online looking. Now, years ago when there wasn't online, portals that you can look at, it was a little more difficult, and it was hard to gauge different properties and stuff like that. So we're in a fast market, and we're going to be like that for the rest of time, and because everything's online.
But do you still think like the parents, because I remember looking for a house and, way back in the day, my mom and dad telling me all their thoughts and processes on the house. But I mean, like, they don't know exactly where the market's at, right? So like when you go in, they may be able to see the different houses, but is there still that tendency to be like, we can get this cheaper, But then when they go in, like with you guys, you'll end up saying like, no, this is competitively priced.
Yeah. No, I think that generation is gone. Not gone, but
less.
But that generation is not doing that. They're older, and the generation that are looking, the parents are not saying we can get a better. They'll say let's see if we can get a deal here, right? That's the one aspect of it. But they do look at all the the windows, the shingles, the furnace, and all the the expensive items that you have to replace. And they're looking at that, and they're basing their price on if they have to put money into it within the next 2 to 5 years. So if you're buying a house and let's say they're asking $800,000 for it, and you got an old furnace, well, furnace can everything's expensive. Like a furnace is like $5,000 to $7,000.
Yeah.
And so they're going to go, okay, we have to put a furnace in, maybe not right away, but that furnace can break down any time, and that's money out of their pocket. Instantly, you wake up one morning and say, hey, life's great, let's plan a vacation. All of a sudden the furnace goes out in the afternoon. Well, let's just wait for that vacation till next year. You know what I mean? And it happens. Believe me, a lot of people go through that, and just because of an expensive item in their house. And we had our pool heater went out, and because of the torrential rain,
that just happened to me.
With the pool heater got destroyed.
I don't know. The electrical panel shut off.
Yeah.
I actually tested the water to see if I was going to get electrocuted first.
So there's a $5,000 item there that I have to pay.
Was it the heater?
The heater is garbage now because of the heavy torrential rain that got into that heater. And it just I don't know what happened to it anyway.
Man.
So there's an expense there that I didn't expect, and I didn't expect that this year. I thought, heaters can, pool heaters can last for like 5 to 10 years or more than close to 10 years. So, and I've had that pool. I'm not sure how long I've had it for.
That's funny. That's the exact same thing. We were trying to put the pool on this morning, and it kicked off after the storm last night.
Yeah.
And I thought there was an electrical issue, but I
maybe your heater's burnt out because of the something happened.
Can we call the same guy, see if we can get a 2-for-1?
Yeah, let's do that. Let's do that. We got to get a deal. That's it. But otherwise, but those are the situations out there. But again, the public, the consumer knows pricing, and that's when the seller has to make an adjustments. And that's why we call for feedback on realtors that show our listings and say, hey, what did your clients say? And they just, a lot of them will say, you know what, for the condition and for the location of the house, they'll say, that it's a little priced a little high.
Do you think just like is now a good time because it just went down a quarter point? And I heard a lot of people say, reduce the house now because it went down a quarter point. Do you think that is going to have any effect whatsoever on?
I don't think it has an effect that much, but I'll tell you, now is the time to buy, because when it hits that another quarter or another half point, look out. That house that maybe that is $650 value today will be $700, and that's 6 months away from now.
Yeah.
And so if you buy something now, you will make maybe some equity growth on your house. Your net worth is going to go up, $25,000 to $50,000 in 6 months, and it will happen.
Well, and because people got to realize that when rates go down, affordability will go up.
Yeah.
So that means that the person who was qualified for $600 or $650, maybe they can qualify for $675 or $7 now.
That's right.
So it puts people in a different price bracket, which will end up pushing prices up a little bit too.
Yeah.
Given that scenario, are we seeing sellers hold off on dropping prices, knowing that, listen, the rates are going to drop, more people are going to be in the market to spend that money? Are they holding off dropping prices?
Yeah, I think holding off dropping the real estate prices. I don't know. I think.
Yeah.
What do you think, Rob? Do you think it'll be?
You know what? No, they're not as. There's no motivation for them. They're hanging on. I was just looking at a couple of listings yesterday, and I saw that it had 329 days on the market. Oh. The other one had 300 and some other days on the market. So they're hanging on.
And
to
they might
price.
be. And I think the reality too might be some people are at the price they have to be at in order to sell.
Yeah.
Like some people might be like, listen, if I drop it any further, I'm going to be underwater.
Yeah. So, but I am seeing a lot of listings that have been on the market for like more than 150, 300 days, all that kind of stuff. So those people are hanging on, thinking somebody is going to give them their price. Well, if they list their house for 3 years, eventually they'll get their price because the market's gone up. As long as they don't move the price of their house up, eventually the market will catch up to that price.
Yep.
Over the next 10 years, there is going to be a humongous transfer of wealth from current boomers to their kids. In Canada, the suggestion is around $2 trillion. In the States, about $16 trillion. That's a lot of money for people to invest, do what they want to do for fun, and buy their next homes. Rob, how is the next decade going to be in terms of buying and selling homes?
I've always said it's going to be unbelievable because there is all this money that's going to be transferred down. The economy is going to run like booming. Housing's going to run booming. When people get money as inheritance, they have a tendency of spending it a little more than the people that worked hard for it and saved it. So you're going to find that, there's going to be people buying houses. There's going to be people buying boats. There's all sorts of toys. People, putting pools in their backyard. They're going to be doing all that. The housing market, usually I say, doubles every 10 years. It's going to be shorter than 10 years. And that's why I say buy a house now before that happens. And it happens slowly. It's not going to be like everybody's cashing, everybody's going to die and the next generation is going to inherit that $1 trillion. It's over a course of so many years, and every year, and it's happening now as we speak. It's not going to be it is happening now. There's people that are in their 80s that are passing away, 70s and 80s and 90s. These people have fortunes. They're boomers that save their money. They have fortunes, and they're passing that money down to their kids and grandkids. And you know what? And some of them are good savers, and some of them are going to spend it. And that's what's going to drive the real estate market up. And so that you got to get in there before that boom happens, and it will happen. I do feel that we're going to see the market go up in value in 2026 and 27, and we're just in a little bit of an incubator right now in the market, and when it kicks in, look out.
Well, CMHC just had a recent study, an article that came out, and they were saying that they are expecting housing prices to be back at peak levels in 2021, 2022 within the next couple of years.
Oh no! See, 2020.
Well, and that's going up almost 20%.
That's
right?
my prediction. 2026 and 2027, you're going to see. If you think you can't afford houses now, wait till you see that.
And it's like how many people, like we had a record amount of immigration, right? People who typically come into the country, they're going to wait 2-3 years in order to buy a house because they're going to get settled.
They're good savers.
100%, because a lot of people will live with multi-generational homes. We've talked about that before.
Yeah.
So I can save money. We can buy a house together. So I 100% agree, and I think it's going to be a great real estate market within the next 3 to 4 years.
For the next 20 years.
Yeah.
I do. I really, truly believe that.
So in saying that, is now the time, if you're a would-be investor, is now the time to start planning for that? Because 3 to 4 years is going to happen pretty quick.
It is, absolutely.
Yeah.
I'm looking at it. I'll be like, once I finish my 2 projects, which I'm finishing in the next 2 weeks, I'm already on the hunt looking for some other real estate, and I won't do 2 major renovations at the same simultaneously. Believe me. Oh yeah, that was a little bit aggressive and a little bit ambitious, but it's
not like you at all, Rob.
No. But I will be looking at I'll be looking at buying more real estate.
Yeah, me too. I think the long-term fundamentals hold true, right? I think I wrote what not to buy is speculation. I think a lot of people learn you don't buy on spec. You don't buy thinking and hoping and praying that it's going to go up. It's not a great strategy.
No.
But if you buy with the fundamentals in place that, hey, will the revenue be more than the expenses? As simple as that. And can I hold on to this for the next 5 to 10 years?
Yeah.
Right? And I think we've talked about this many times, but you will do just fine over the next 5 to 10 years. If you were to buy something today, put it into a 5-year or a variable with a long-term strategy.
Just before the break, we were talking about, for the next 10 years, this housing boom is going to return. If you're a newbie investor, you're thinking about getting into the real estate game, you've heard that house prices every 10 years basically double, and you want to cash in on that or try to, bulk up your investment portfolio. Where do you start? How do you start? What should people be doing right now?
They should be buying multifamily, small multifamilies, duplexes, triplexes, fourplexes, and live in it, as Brian was saying here before. That is the way to go, and you will build wealth fast that way. Mm-hmm. Now, Brian, when you're buying a single family home and it's your first home, you can do 5% down.
Correct.
Now, if it's
under $500,000.
Is that right? Okay.
Yeah.
So now, if it's your first home and it's a triplex, the down payment is a little heavier. Am I correct?
You can still end up buying a triplex with minimum down payments if you occupy it as a principal residence, right?
Okay.
So if you're over 500 to 999,000, you got to put down 10% of anything over 500. It works out to be, let's say, 7.5%.
Yeah, right.
You can still do that with a duplex and a triplex if it's going to be owner occupied.
Gotcha.
So, and I 100% agree, because once you start doing that, you're building wealth because you're paying down a mortgage.
Yeah.
I think you're buying it at a great time as well too, and you're subsidizing your living.
Yeah.
Right? Like, I think to get something that cash flows today, which means that your revenue is going to be more than your expenses, is hard. But like, I remember when I lived in our old house there on Tuckett Street.
On Tuckett Street, 28
right?
Tuckett.
28 Tuckett, right? You got to do a tour on that one time. I wonder what it looks like today.
Yeah, no kidding.
But I was living for cheap because I was renting out 2 floors, right? So when I looked at my mortgage payment, 50% of my mortgage payment was being covered, almost 60%. So, you're still paying, but you are living way cheaper than anywhere else.
Yeah, it is the way to go if you're if you're looking to build wealth, first time buyer.
And I also think it's a great launch point, because I think you'd agree on this too. If that is your first place, when you're ready to make the move, it's an easier one to keep, rent out, and then buy your next one. Because what you can do is you can still buy your second property if you're going to live in it with 5% down or 10% down. You don't have to put down 20% down just because it's your second property. So long as it's a principal residence, you can put down less than 20% subject to qualifying. So that's a great way to keep an investment property and move on to your next one.
Awesome. That's the way to go.
So here's a question. Are there opportunities in Hamilton to do that right now?
Absolutely. Southwest is one of my favorite areas, Southwest Hamilton. It's where you and I first bought in Hamilton. And actually, the ironic story is I bought my first investment property in Hamilton. It was 28 Tuckett. And then years later, Brian buys the same house that I sold. Now, I didn't sell it to him, but there was other couple of sales in between us, and bought the same house, 28 Tuckett.
There was just good vibes in that house, Rob.
Yeah,
I don't know.
I remember, and I rented it out. And I did well on it. I did well on the resale of it, and you probably did well on the resale of it too. So
that was my Mission 35 house. That was the house that I sold to pay off my mortgage when I was 35.
See that?
That was Tuckett. See, that's a good luck house. Whoever's in 20 in Tuckett today,
buy that house. No, but we both bought the same property. We're a generation difference. And we both made money on that, and that's a perfect example for people to follow and do the same thing. Do the duplex, the triplex, fourplexes, whatever. If you can find one that's decent, that's in decent shape, and it'll generate cash flow. And if you're living in it, even better, because you can manage it yourself, you will do well. And 28 Tuckett is a success story for Brian and I. And it's ironic that we talked about that, and then we find out we bought the same house.
It's so funny.
It's what a coincidence that is.
And I think it comes down to a little bit of sacrifice as well too, in the sense, like, I know when I was there, like I lived in the smaller unit and rented out the bigger one.
Yeah.
Right. And it's kind of like, it's a little bit of sacrifice. So if it's your first place, your first house, and you got to live in a little bit smaller area for a year, 2 years, 3 years, it's in my opinion, very small price to pay in order to build extraordinary wealth.
Awesome.
Good one. In our last minute, we're saying goodbye to CEO Tim Hudak of the Ontario Real Estate Association. He stepped down after 7 years. Last day is August the 2nd. What qualities does the next leader of OREA need to have?
I think they should have some experience in the real estate industry. Now, I'm not saying Tim Hudak didn't have that, but he did not work he wasn't a realtor. He wasn't a broker. He doesn't, like the understanding of how us realtors in the trenches, how we think, how we operate, and how things go with us out there. I mean, he's done a good job, and he's implemented a lot of new different things, which I think is a little bit too ambitious, and he's created a tremendous amount of paperwork and everything else like that. And I think he's just following the trend that's happening in the U.S. But I mean, hey, you know what? Congratulations to him. He was there. He was great for the Ontario Real Estate Association. Let's see who they pick next.
It'll be interesting. You can listen to our show online through Spotify, iTunes, Google Podcast, Stitcher, and many more. Just search for the Golfi Real Estate Show in your favorite podcast platform. Smash that follow button so you never miss an episode. Thank you for listening to the Golfi Real Estate Show. We're back next Saturday at 9 on 900 CHML.